Okay, so let's get into now the youth course. We are going to start learning how to do our taxes. So first, we got to figure out exactly what our taxable income actually is.
All right, so by now you've already learned the bad news about taxes. You're going to have to pay them, and you don't get much choice in the matter. But there's also some good news, too. Not all of your income is taxable. When you file your taxes every year, you're essentially reporting how much you've made in the past year so that the Internal Revenue Service and your state's Department of Revenue know how much you owe in taxes. But that's not all you report on your taxes. If it was, people wouldn't always complain about how complicated taxes may seem at first. You also have the option to report a bunch of expenses that can decrease the amount of your income that's taxed. This means lower tax liability for you, and it can even result in you getting money back from the taxes that were withheld from your paychecks. In this video, we are going to learn one of the most important parts of doing your own taxes: how to calculate how much of your income can be taxed. Let's get into it.
This is the reason why I've canceled my doorbell camera subscription.
This brand new subscription.
Okay, so your income starts off fully intact, your gross income. That includes every single cent of income that you brought in over a year. Now, if you're like a lot of people and all your income comes from one job, then the money you made from that job is your gross income. If your job pays you a $50,000 salary, then $50,000 is your gross income. Or if you worked a total of 1,500 hours at a job where you made $23 an hour, your gross income for the year is $34,500. One of the easiest ways to find your income from a job is on your last pay stub of the year. Pay stubs show your year-to-date total earnings, meaning everything you've earned all year up to that paycheck. On your last pay stub of the year, that's the same as your gross income from the job. But a lot of people make income from more places than just one job. Some people have a second job, maybe some investments, and possibly a little interest from their savings. Your gross income is all of this added together. Now, when tax time comes around, your employer or employers will give you a W-2 form. And if you've made at least $600 from anywhere else other than your job, you'll also get a 1099 form. These are basically just receipts to show you how much you've been paid over a year to help you with filing your taxes. But wait a minute. The amount on your W-2 is lower than your income was supposed to be. Where'd your money go? Did your boss steal it? Nah, that's not it. Remember, throughout the year, money has been automatically taken out of your paycheck to pay for your benefits. Things like employer health insurance and retirement contributions. These are what's known as pre-tax payroll deductions because they reduce your gross income before taxes come into play. So from the very start, some of your income is non-taxable because it doesn't even show up on your W-2. When you go to file your tax return using tax form 1040, this gross income that is shown on the W-2 that you received will be your starting point. Next, we're going to need to adjust your income. Not like randomly, no. Adjustments are certain expenses that can be used to further reduce your taxable income. They're pretty similar to those pre-tax deductions, only they cover things that your employer might not know that you're paying for. So they're not going to be automatically accounted for on your W-2. There are a ton of adjustments that you might qualify for. Plenty of adjustments are education-based. Students can adjust their income based on how much they pay for tuition, plus whatever money they use to pay down their student loan interest. And teachers can adjust for some of the cost of the materials that they buy for their classrooms. If you're your own boss, like you're a business owner or a contract worker, then there are some adjustments that mirror what an employee might receive from their employer for things like health insurance payments, half of Social Security contributions, and retirement contributions. There are lots of other adjustments you can have. When you go to do your taxes, you will get a form to fill out that will walk you through every possible adjustment. Or if you're using a virtual service to do your taxes, you just need to fill out a few questions and then it will do the calculations for you. Once you have figured out all of your adjustments and then subtracted those amounts from your gross income, what you are left with is your adjusted gross income. Pretty sure you can figure out how that got its name. Now, your adjusted gross income, or AGI, is one of the most important things on your tax return. This is because there are itemized deductions, we'll talk about those in a second, and tax credits, we'll learn about those in a later lesson, that will only apply below a certain AGI. This is why it's important to...
That's really, really important. The lower you can get your AGI, the more you can apply other tax credits and other benefits to lower the amount of your taxes even more. Getting that AGI down as much as you possibly can every tax season is critical.
Take every adjustment that you qualify for in order to save even more money later on down the road. Okay, so now you've got your adjusted gross income. That super important number, but we're not done yet. Almost. We just got one more thing to do. Now you have to decide whether or not to take a standard or an itemized deduction. This is one final attempt to reduce your taxable income so that you pay as little money as possible. The IRS really gives you a lot of opportunities to keep your money, don't they? Now, this is a choice. You have to take either the standard deduction or the itemized deduction. You cannot choose both. If you choose the standard deduction, then that reduces your taxable income by a set standard amount, a whopping $12,950 in 2022. Another thing that's great about the standard deduction is that it's super quick because you don't have to calculate anything. You just take that. That's it. Now, an itemized deduction is actually a lot of little deductions rolled up into one that cannot overlap with the standard deduction. You cannot choose both. You have to pick one. Now, the itemized deduction will also involve a little math to calculate, but if it saves you money, that's worth the extra effort, right? Some of the most common expenses that can make your itemized deduction worth more than your standard deduction are if you spent a lot of money on large medical bills, if you paid a lot of interest on your mortgage, or if you suffered a lot of damage from a natural disaster. If you ever find yourself in one or more of these situations, go ahead and do the math on what your itemized deduction would be. Then choose either the standard or the itemized deduction, whichever's bigger. Okay, so now you've got your AGI, and you've picked which deduction you want. Now what? No? Nothing? Nothing? You're done. You're done. That's it. That's all you need. Once you figure out your AGI and you subtract your chosen deduction from it, what you are left with is your final taxable income. This is the amount that your income tax will be based on. Whew. If all of this still seems a little confusing to you, don't worry. Tax Form 1040 has detailed instructions on this whole process, so you can always check that if you ever forget this. Now that you've figured out how to calculate your taxable income, you are ready to move on to the next step in the process. In the next lesson, I'm going to teach you how tax brackets work so that you know which one you're in and you know how much you owe. See you then.
And we're going to go right into tax brackets.
Your child needs these 3 key factors to get into an Ivy League or top 25.
Hey there, it's Justin again. In the last lesson, you learned about the 3 types of tax systems. Progressive taxes in particular are a little difficult to understand, so in this lesson, you'll discover how they work using tax brackets. By the end of this lesson, you'll be able to calculate personal income tax liability using tax brackets. First, we'll learn how tax brackets work and how your income gets assigned to brackets. Then, you'll learn how marginal tax rates work, because it's a little different than what most people think. Once you've got the basics down, we'll do some example calculations so that you can see the process in action. And finally, you'll get a chance to observe how tax forms try to cut down on the headache by giving you super quick instructions to perform these calculations come tax filing season. Before we get into all the details in tax calculation, it's important to understand that tax laws change every year, and they're different for every country too. This video is based on United States tax calculations from 2021 and 2022, so it might not be the same in future years. Always verify tax information and instructions directly from your country's tax office prior to doing tax calculations. You learned previously that progressive tax systems increase the tax burden on those with higher incomes. But there isn't some magic formula to calculate how much you owe based on your income. Instead, we split income into ranges called brackets. These are the tax brackets used for taxes in America in 2022. Your tax burden is determined based on which bracket you fall into. These tax percentages are known as marginal tax rates. Oh, right. One small thing to mention here. This is based on taxable income, meaning your income after you've taken out any adjustments and deductions. If you need a refresher on how to calculate your taxable income, our financial literacy course has a lesson on that as well. Let's say your adjusted gross income was $12,960, and you took the standard deduction of $12,950 in 2022. That leaves you with a taxable income of $10 whole, putting you in the first tax bracket. In that bracket, the marginal tax rate is 10%. So you would pay a whopping $1 in taxes. Oh no. Any taxable income up to $10,275 goes in the first tax bracket and is taxed at a rate of 10%. So the maximum that you'd ever pay in the first bracket is $1,027.50. Here's where tax brackets start to get tricky for some people. Let's say your taxable income for the year was $10,276, putting you just barely in the second tax bracket. A lot of people mistakenly think that the marginal rate for your particular bracket applies to all of your income. In that case, with $10,276 placing you firmly in the 12% bracket, you would owe $1,233.12. But that's not the way tax brackets work. The way it works is that your taxable income fills up the tax brackets. And only when one bracket is full of money does your money then start filling up the next bracket. The marginal tax rates are only applied to the amount of income in that particular bracket. So the first $10,275 is always taxed at only 10%. And only that little amount that overflowed into the second bracket will be taxed at 12%. For a taxable income of $10,276, the first $10,275 of that completely fills up the first bracket. And only that last dollar makes it into the second bracket. So most of your money will only be taxed at 10%. And just that last dollar will be taxed at 12%. Earning that one extra dollar and jumping into the next tax bracket did not massively increase the amount of tax you owed. It actually only added 12 cents onto your liability. So, despite your taxable income placing you in the 12% tax bracket, your tax burden, or the percentage of your income that you pay in taxes, is still just above 10%. This is actually what marginal tax rates are meant to represent, the rate of taxation on your last dollar of income, not your total tax burden. Being in the 12% tax bracket doesn't mean you paid 12% tax on all of your income, just on the last portion. But most people won't just have a single dollar in their final tax bracket. Your taxable income will more likely fall somewhere like this, with your final tax bracket filled up partially. But the idea is still the same. The amount in the first bracket is taxed at that rate. The amount that landed in the next bracket is taxed at that bracket's rate, and this continues for each tax bracket that you had money in. When you have money in more than one or two brackets, the math can start to get a little complicated. So let's do an example to see how it works. Let's say your taxable income came out to a nice, clean $100,000. Start from the bottom, where your taxable income reached. If that's the point where $100,000 lands, and the previous bracket ended at $89,075, then we could subtract that to find that only $10,925 went into the 24% bracket. Your remaining income reached all the way to the end of the 22% bracket, to $89,075. From the previous bracket's minimum of $41,775. So it took $47,300 to fill the 22% bracket from beginning to end. We can keep doing this all the way to zero, taking the maximum of each bracket and subtracting the maximum of the bracket below it to find how much it took to fill each bracket. Once we know how much is in each bracket, we just multiply those amounts by each bracket's tax rate to find how much is owed from that bracket. And we add them all up to find the total tax liability. See? Not quite as complicated as it first seemed, is it? Pause the video now and try the additional examples that you could find in your notes. When you actually go to file your taxes, you won't have to do all this math. The IRS has made things even simpler by providing an instruction form to help you calculate your tax liability. It's full of tables like this one from 2021, and all you have to do is find the range with your income, and it will tell you how much you owe. If your taxable income is over $100,000, you do have a little more work cut out for you, but the instructions will walk you through every step. Put your taxable income here, multiply by this, and then subtract a given amount. And just like that, you will know how much you owe. But don't go pulling out your wallet just yet. Just because you calculated your income tax liability doesn't mean that's how much you need to pay. Your employer may have withheld money from your paychecks to help you pay your taxes. By the time tax filing season rolls around, most of your tax liability has probably already been paid through withholding. In the next lesson, you'll learn how payroll deductions work, including how withholding factors into how much you've already paid, how much you still owe, and how big of an unexpected refund you might get when you file your taxes. See you then!